Okay, hello everyone. I'm Daniel Flatt, and as Manesh was kind enough to introduce, this is the panel focusing on the evolution of typologies and the role of RegTech. Just a few sort of words from me. The methods used to launder proceeds of criminal activities and to finance illicit activities are in constant evolution. As the international financial sector implements detection standards, for example, criminals will inevitably sort of find alternative channels to conduct their illegal business. This is a cat and mouse game that has been played out for years and will certainly continue to do so. Institutions such as Flatt have gone to some lengths to assist countries in identifying, assessing and understanding money laundering and terrorist financing risks they are exposed to. And once these risks are properly understood, countries are able to implement AML and counterterrorism measures to mitigate. The HKMA, just for an example, recently issued additional guidance for banks on managing AML amid the COVID-19 pandemic, following on from an April circular which encouraged the use of technology to enable remote onboarding and account opening. Naturally, there has been a big concern about the very present dangers of remote onboarding, as the practical implications of many bank inspectors exercised their exploration of RegTech solutions. Machine learning produced a number of false positives around in their screening and monitoring systems. With the help of government-led initiatives, specifically sort of private-public partnerships as a means to address these threats and changes in customer and criminal behaviour, there's been regular updates on commonly used typologies in order to sort of support this. I quote here, these collective efforts can help enhance the overall effectiveness of cooperation and information sharing between the public and private sectors on typologies and best practices. I'm quoting the HKMA. However, depending on who you speak to, there is still a distinct sense that within banking circles, typologies are a nice to have, can often end up never being used or more likely treated with the necessary seriousness that perhaps they should. So I am very excited to have with me today Richard Carrick, who is the CEO of Crime Stoppers International Asia, Henry Yu, who is the Regional Head of Financial Crime Compliance at Natixis, and Archana Kotecha. He's the Asia Regional Director and Head of the Legal Department for Liberty Shares. Hello, everyone.
Hello.
Okay. Hopefully Henry will join us in a minute. It wouldn't be an online session if we didn't have some technical issues, but let us not sort of stop us in our tracks. Before we get into the meat of this particular panel session, Richard, I just want, given your sort of background, just want to get from you a nice pithy description of what a typology is, and then what exactly it should be doing in this process of crime detection.
Yeah, sure. A topology basically is a method of doing a crime. It's a more common method of doing a crime. So something that's kind of used several times over by multiple players, that in itself is a topology. I would further break that down into two parts. So I would say there's a simple topology, such as use of an offshore shell company. And there's complex topologies, which are a grouping of simple type of topologies. So you're using an offshore shell company, but you're also using over invoicing on trade between them. You're using lots of correspondent banking accounts, things like that. So putting all those together then creates what I call a complex topology. As far as the second part of your question, what do we, how do they fit in and what do we use them for? Well, for financial institutions, they can use these as scenarios for transaction monitoring. For law enforcement, they can use that as a way to know where to start looking for criminal activity, and then being able to probably have an idea as to how these folks are going to operate and what do you need to do in order to further detect their activity and stop them. So that's really what it is.
There's components in that I want to unpick a little bit later, but for hopefully Henry's joining us. But for now,
Hi.
Hey there, how are you doing?
Hi, I'm good. I'm sorry.
Don't worry at all. Richard was just giving us a nice pithy explanation of what a typology is in its method. So we'll move into my sort of first sort of major question, which is how has, if at all, the events of the last 7 months of the pandemic influenced regulator activity on typologies or banking activity on this? Has there have you seen anything that's sort of been notable in the last 7-8 months? Richard, I'll kick to you again. Henry, over to you once Richard gets back to us.
I think the pandemic actually did affect the, the kind of like typologies and what were the trend that we have been seeing. And in particular, you see, different people using different, what we call excuse related to the pandemic side to commit different kind of fraud, either in the retail side or in the wholesale side as well. In particular, there was another interesting observations, on top of what we call kind of like a traditional using pandemic itself as an excuse, but we can see that actually because of the economic downturn as a side effect of the pandemic, you can see a lot of companies get default and they are coming into some sort of like traditional way of committing a fraud, but has never been, disclosed. For example, you see quite a number of cases in Singapore or involving oil company, because of this pandemic plus the crackdown on the oil prices, they all went bankrupt and liquidated. And it is, and what you can see that if you go through the liquidation process, you can see that they're not running something new, but they're just running basic, invoice financing for all this kind of thing. But this is, I would say that it is a side effect of, the pandemic drive down the economy, and a lot of fraud cases has been arising up as a result.
Here we go. Can you hear me now? Sorry, I'm on mute. Henry, to your point, what have you had to do in order to tackle these? What's basically happened?
I think from my end, from my end, one of the things is very important is to making sure people be aware of the kind of typologies that we are facing, the new type of typologies or upcoming typologies that we are facing. But on the other hand, we always try to proactively to look into into this kind of new event, right? We proactively looking at whether any of our existing relationship that might be subject to further due diligence, further review in this event as well. I would say so.
And are you getting any sort of support at a regulatory level or at any kind of institutional level? I mean, when we spoke a little bit about this last week, you mentioned there's been a slight shift in emphasis from how the regulators look at typologies. I'm not sure that's necessarily just primarily because of COVID, if at all. But you have noticed a shift there, Henry, right?
Yeah, I think that's true. I think it's going back to the what we discussed early last week about the kind of public-private partnership. I think we discussed a lot about that with Richard together. About different regulators around the world is setting up different PPP initiative as well. They issue different typologies papers. Try to share the kind of information amongst banks or financial institutions, big or small, which is under traditional way that we even if we file NCTR, we are not allowed to share with any of our peers. So I think that is one of the initiative. Going back a little bit further back, not only because of the virus situation, but more sort of like the recent developments, from different regulators or governments around the world.
And how helpful has that been to you? I mean, with the emphasis of providing typologies to you, I presume that takes a degree of work off your plate, but there are implications to that, right? There are practical implications to having these lists. You need to do something about those lists.
I think we do, right? We do. We try to look at it from not to just take it as it is, but more important is how to react to it, right? How, like for example, traditionally, I think most of the financial institution is still using, traditional way of, transaction monitoring, programs to monitor different kind of suspicious activities, kind of things like that. But it will give it a more sort of like a timely, or not just once a year, but more event kind of difference, review to give it a cycle of, our what is our setting? Is it the kind of setting that is, timely reflected the most, fashions or what you call the typologies of the things that we don't really have to wait until, the annual review for each and every years as well.
I'll talk about the technology component of that just a little bit later. But Richard, hopefully you can hear us well now.
Yeah.
What's your take on how COVID has influenced the evolution of typologies, if at all, or what basically is would you say has developed over the last sort of year or so?
I think the main thing that's starting to come out, and it probably echoes what FATF have actually put out too. There's a lot more fraud scams coming out, particularly around some of this government aid that's coming up. It's not uncommon for people to be called by somebody saying they're from the government agency. We want to give you some aid money. Give me your account details, and then boom, it goes away. Their money gets stolen out of their account. The other stuff you see as well is around counterfeit goods. So there's a lot of things like PPE, pharmaceuticals, and the like that are starting to flood the market now. We even have governments being robbed too. Like the Italian government got a whole bunch of sort of substandard counterfeit stuff in, and that was a big problem. So we've got those. There's a lot of sort of cyber crime and like the CEO fraud scams as well, where they're kind of pretending they're the company boss. Everybody's working remotely, and they get a mail from a senior manager asking them to do something, release a payment or the like, and that's fairly common. Another big thing is a lot of money laundering is actually carried out with cash. And that's probably the bulk of it. A lot of money launderers aren't super sophisticated. They still deal in cash, and they start moving things through front companies like bars and things that are capital and cash intensive. And so now these folks with the lockdown are now having to move to other means, like the Hawala people, all cash, but now you have to go online. And so this is actually a bit of a weakness for them, because a lot of these folks aren't used to dealing online, and sometimes they don't get it right. A lot of red flags are starting to pop up where these people are jumping in and opening up new accounts. So those are just some of the ways that it's changing.
It might sound a little glib then to assume that perhaps it's because of that it's a little bit easier for financial institutions to detect or monitor this stuff, or is that sadly not the case?
In some cases, it is. If somebody who's normally a Hawala person then sets up an account and starts to conduct their business through it, all kinds of red flags sort of pop up. So that makes it easier. But the thing that makes it more difficult is within a financial institution, all the employees are working from home and they're a bit more disparated. So maybe some of the traditional banking organizations may not be sort of perfectly equipped. They're still trying to bed that process down. I would say some of the fintech companies out there, like the payment providers and the digital banks, they're a little bit better at that.
I'll bring us back into those two sort of points later, but I'd love to bring Archana in. Your role is a very, very interesting one. Would you be kind enough to sort of take us through a little bit of what you do, and your connection with financial institutions in regards to typologies? This is obviously relating to criminal activity.
Sure. So thanks for having me. And it's interesting. I'm a human rights lawyer moonlighting on a financial crime panel. So please bear with me as I take you through what I do. I work for an organization called Liberty Shared, which was set up about 8.5 years ago. And we set up very much with the view that we were going to look at money flows that were attached to human trafficking. So one of the big problems we realized straight off the bat was that information and data was not flowing from the front line where slavery was happening to the desk. So we started to experiment with different ways of actually conveying that information to the right stakeholders, such as financial institutions, law enforcement agencies, etc. And we started to build typologies. The typologies we built essentially tracked the movement of goods and people across different jurisdictions through different perpetrators, aiders, and abettors, up to the financial destination, the actual destination of the goods. We tracked the recruitment of people, etc., through invoices, etc. We were able to then piece together a picture of what slavery looked like on the ground. It was a frightening picture, but one that made it very, very clear that this was a multi-jurisdictional network-based offense involving multiple perpetrators and several large multinationals and banks who were banking these accounts and moving money around, etc. So we started to share the typologies that we built with banks, with law enforcement agencies, and other relevant stakeholders. with a view to really sort of, educating them about what it is that we were seeing from our vantage point and what they could be doing at their end in order to bolster their compliance efforts in this space. So we've, over the last few years, built technologies looking at different sectors such as fishing, garment, palm oil, rubber, sugar, and we've shared those with the relevant agencies. Some, have, it's been met with varying degrees of success, I'd like to say. And in some cases, banks have been very receptive to receiving the typologies because there's been a growing momentum and highlight around the issue of modern day slavery and human trafficking. Many of the financial institutions now have to file group reporting obligations under the Modern Slavery Act, for example, or the Australian Modern Slavery Act and various other pieces of legislation. So I found that very rapidly the typology sort of sharing became accompanied with a lot of compliance training that involved looking really at what it is that modern slavery is, how does it present itself, what kind of risk could it present to the banks? And the questions that emerged in response to that were very much, give us a box of indicators that we can use to find this crime. The answer isn't simple enough. And because it's such a multi-layered and complex crime and a crime of many crimes, it was very difficult to identify it with a bunch of generic indicators. So the idea was that, in addition to adverse media checks and various other KYC procedures, this would be layered with the typologies, a better understanding of the crime, and the application of indicators in order to move people forward in their efforts. Some places are ahead of others. I think there's a different response rate, certainly in Asia and Southeast Asia as compared to Europe and the US. And it's been a privilege to do this work. And, we've, for a very long time in the human trafficking space, focused on the criminal justice approach, which we know has been extremely limited for a number of reasons. And having this other alternative, this different way of pursuing trafficking networks has certainly opened many doors, even though it has its limitations.
Implicit in your comment is the fact that there are different responses. Presumably, some of these responses from the financial institutions are less than welcoming. Can you give some colour as to why that might be? I mean, why would a financial institution not be in a position to want to take on someone else's hard work to improve their own?
I mean, it's, some of these are sectors and accounts that are very large accounts and very large sectors that are banked. They're, institutional clients. They've been there for decades probably. And it's a big thing to take on and to escalate and to fight internally as well. And, of course, the banks, although we do a lot of data sharing with banks, the banks don't tell us what it is that has happened with the data once we've shared it with them. As frustrating as it is, it's just a reality of the way the setup is, and we have to accept it because of legislation, etc. So, I think some of the reluctance has really been because these are very large accounts. But what has subsequently happened is they tend to be relating to sectors that are very well documented to be linked to modern slavery. So, it just takes one or two banks to start taking the initiative and to drop clients because of their sort of taint with modern slavery, for others to really wake up and to smell the coffee and to want to do the same in terms of managing their risks and liabilities. But we are still far away from such a position. We've seen recently, for example, Rabobank, Standard Chartered, Citibank drop some of the palm oil giants because of liabilities attached. And, I think this will become more common over time. But this conversation about, the risks and liabilities and reputational damage that attaches to modern day slavery is not taking place in many boardrooms in Southeast Asia or in Asia. It needs to happen a lot more because this is a serious risk and it's one that is here to stay and it's not going anywhere. And I think COVID has just, really enhanced a lot of these vulnerabilities as well.
I want to bring in Henry on this, but just before I do, pithily as you can be, how do you build a typology? And when you put this together, I presume there's some question marks. There may be question marks from the finance institution as to how useful this information is, how credible is it, how have you done, the due diligence required to ensure that if you're going to onboard this information, it's going to actually have a positive difference. How do you even start that process?
Oh, we hired the best. We have a team of fantastic data analysts who are ex-WorldCheck people. And, we basically are very rigorous with the information where it's got from, open sources on the ground. That's why it takes us about 4 months to build one typology. And, it's not sustainable long term because we're a small team. So, it's a whole range of open source and confidential information. We divulge as much as we can, documentary evidence, etc. And, we get as close as we can with sharing where the sources are, whilst also protecting any sort of confidential sources that we might have. But, we also have investigative capabilities that we have used to bolster information that is available in the public domain. And because we had a partnership with WorldCheck, we were already gathering information from across several jurisdictions in the world through a network of NGOs relating to what was going on the ground there. So that was already quite a rich data set that we had relating to assets, organizations, and individuals linked to modern day slavery. So it was really a question of building on our networks, drawing upon our networks, and assembling the information and piecing it together, extremely well sourced, very well documented line by line. And we would allow banks to see the information behind the typology if they felt that it was necessary for them to do so.
Fair enough. Henry, there you go. It's as easy as that. You take the information, you use it, and there you're done. You're sorted. It's just as simple as that. Why isn't it happening?
Well, I think they were. I think rightfully say that. I think it is happening in major banks, international banks, in banks where like us, more sort of like European centric or US centric, because there were more sort of like appropriate law and regulations guidance on that. What kind of you're obligated to do that, and the kind of awareness of corporate responsibility, reputational risk, is very much higher as well. But I think one of the other challenges for smaller banks or jurisdictions, banks in their headquarters in jurisdictions where, first of all, if they do not have such requirement, right? That's one thing, because I think FATF is one of the 11 type of practical offense, that you need to be implement as a kind of FATF or FATF member. But as of today, as we know, not all the country in the world or not all the members in the world actually, at the member stage, they do have its explicit, legislation on this respect. So I would say that I totally agree. It works better for places, or for institutions, with with their home regulators or with the local regulators have such regulatory requirement. That's one thing. On the other hand, it's a kind of like a kind of education is a kind of mindset as well. It's a kind of I do agree that they are doing a very good job. They're really doing hard in education. And for me that is the key, because if you look at, there are some countries, the kind of awareness, the kind of cultural awareness, the kind of thinking about it, at the end of the day, this is something very serious. The level is not the same. So I would say that is one of the reasons why the message may not always be getting across to just like drug trafficking, right? Everybody knows drug trafficking, that is that is not excusable. That is a challenge, and a lot of time in terms of how the challenges is how to cultivate the awareness and the culture in a different types of big or small banks. Again, how that is going back to the topic of public-private partnership. How do you where the message is getting across? A lot of time, this kind of conference information is well shared with big events, with major banks participating in. But how about those small players, other small financial institutes? And this is, I think, is a kind of concept. It's a kind of conceptual things like that. And of course, I would say that at least those good example being demonstrated, like the major banks try to move away, they exit the client, You know, even if it's a big players, you know, is getting more momentum on that one as well. But you know, at the end of the day, this is a progress. You know, these are the big clients. You know, the major banks that exited. Will there be any second tier, third tier, fourth tier banks that they are willing to take them on as well? I mean, that is something that we should be, you know, collaboratively to work on it together.
Archana, you've got a thought
Yeah,
on
I mean,
that.
I was just going to say, in our experience working, you know, just speaking to Henry's comment, 168 countries in the world have some form of human trafficking legislation. And actually, you know, all of those countries also have the corresponding anti-money laundering predicate offense for human trafficking. What we found in the countries that we work in Southeast Asia, the disconnect in actually giving guidance to banks in relation to this issue. We've tried very hard to raise this issue, but you know, it's never a priority. There are always other priorities like fraud, et cetera, et cetera. So, you know, the disconnect between sort of, you know, the legislation existing, regulator guidance, and putting pressure on financial institutions is a very real issue for us.
Yeah, agree. Absolutely agree.
Yeah, I think there's a bit of a simpler, I guess the simple answer from what I've seen within banks is when we get these typologies, they don't get as far as the board. So I don't think the board is consciously saying, oh, maybe we should get rid of this this particular customer or something like that. I don't think it gets that far. It goes to usually initially to the financial crime department. They get this from public-private partnerships. Once they get it, it doesn't really go any further than that. Tends to be the problem is it's quite costly and it's a lot of work to actually put this into your work stream. You would have to put a new scenarios into your transaction monitoring. You would have to go and get your policies updated and signed off, and there's a lot of work involved in that. So if they don't have to do it, they're not going to spend the time and money to actually do it.
Can technology in some way ease the burden on this then? I mean, I think getting this story to the board, that is a personal thing and that is a cultural thing that, you know, clearly individuals, sort of finance institutions have to decide how important that is. But technology might be able to make that easier.
Absolutely. If you have the technology that isn't so hard-coded that every time you want to do a new scenario that you have to then pay money to the vendor to come in and put that in. Let's say you have, and you also have enough connectivity between your data and systems that it becomes easier, then you're more likely to do it. So for instance, if I could myself, if I was, you know, working in transaction monitoring as an investigator or something like that, if I could just simply put that topology into the system, run the data through it and get an output, sure, I would do that. But if it's going to be very, very difficult as it is with a lot of systems, then it's not likely to happen.
Again, I don't know if you have the personal experience or at least the sort of the theoretical understanding, which is how can, I mean, presumably the issue is that data sits in so many different little parts of a financial institution, and sometimes, I mean, we all know that big banks don't necessarily talk to each other at the best of times. So presumably one of the major issues is actually the as you say, the systems being able to just see everything. Is that right?
That's true, because you have, if you take a look at a financial crime department, you've got somebody who's screening customers for sanctions, and somebody else is screening the payments for sanctions. So you've got customer and payment screening. You've got somebody else who's going through adverse news media on a refresh to see if somebody's up to something. You've got somebody else doing background checks on customers and trying to figure out the source of wealth, source of funds. These are all multiple departments all doing this. It would be completely helpful if all the data that all of these folks do or use goes into a single repository, and you can then do the analytics on that to see, is there anything in there against a topology kind of rule that would tell me that there's something wrong? And so I think that's where the big challenge is.
Henry, would you agree with that, or are you in some way or measure getting in that direction?
Yeah, I think I absolutely agree with that, and this is, you know, the kind of challenges for a lot of banks of different size. You know, bigger banks might be doing better because they might have infrastructure to sort of like building up this kind of, you know, registry kind of things like that. Because bear in mind, you know, at the end of the day, those data sources are none of those. You know, the data sources is coming from from the compliance department. It's coming from either from the payment, the operational department, from the operating team, from the front office. This kind of all these kind of transaction monitoring, name screening, kind of tools or things is we are the extractor of the data from different data sources. The finance, the numbers from the finance, the transactions, the trade transactions. I think this is always a challenges for banks and also for people sitting in different corners of the same bank. Like for example, if you are international banks, what kind of data that how much data that you will be good enough to be shared? Will there be any challenges to share like that's very sensitive information? So that is another set of complexity as well, right? Yeah. But yeah, we all try to do that, but it is more, how to say, it is easier to say than actually, there were a lot of, nitty-bitty kind of like operational challenges.
Well, I'm conscious of time, and I certainly don't want to leave on a note where we're just talking about obstacles, because I think I want to leave at least our listeners with a sense of, okay, well, what can I do today to just take a step forward on this? Because, it's been very well articulated about what actually happens behind all this. And yes, banks may need regulatory pressure to move on, but ultimately we're talking about real life crime that has huge effects and stuff. From a practical point of view, Richard, you when we spoke, you were talking about how you operated in your role when you were at Barclays, about training staff, getting them to take it seriously. With the remainder of the time, would you give us some practical tips on how to use typology?
I can, sure. I guess the one thing I did, I'll give you an example from Barclays. I'll give you an example of what I'm doing with the Crime Stoppers now. Within Barclays, the big focus was actually teaching my team. I was running financial crime assurance for the APAC region. Every week I had a team meeting, and we went through a topology so everybody would actually understand how these things work. I also put together a course called Think Like a Money Launderer, and I provided that to the operations team. Because the one thing you find across the financial services industry is nobody really knows how to launder money. Contrary to popular belief, what they do know is how to meet the regulatory requirements. Big difference. Yeah, I know that I'm supposed to have a transaction monitoring system. I know I'm supposed to do the scenarios. I know I'm supposed to have it signed off. I know I have to show all my work if I discount the false positives. All of that stuff, they can tell you exactly that's what you need to do. But if you go and say, here's $1 billion, I want you to go away and launder that. What's the best way to launder it in this situation? They're going to look at you like blankly going, well, I don't really know. And so that's exactly where typologies come in, because it tells them this is what you need to do to launder $1 billion. And so there's a lot of typologies across a lot of, there's capital markets, there's trade finance, you name it. There's stuff for retail banking, a lot of the human trafficking typologies that go across corporate and retail banking, things like that. But it's important for the staff to actually know how to launder money. So they should be on a weekly basis, constantly learning typologies and changes to typologies already learned. It's got to be a continuous learning thing, because the criminals are changing all the time, every time they get found out. So that's one side of it. Now, so training's one thing, but the other thing is around technology. So within my new role with the CEO of Crime Stoppers Asia, we can use these typologies. So particularly things like the human and wildlife trafficking typologies, we can put those typologies as the logic layer in our data analytics intelligence system. Once those are in there, we can feed through multiple data sources. So we can look at things like, the global, companies, house type data, the shareholders. We can bring in things about, shipping, bills of lading, for instance. We can bring in just lots and lots of different data sources. And we also collect data sources from the ground, from investigators, such as the people associated with Liberty Shared, for instance. They collect the types of information we could potentially use to put into our system and run it against all our other data sources. That then shows us, well, where is the criminal activity and what is it? So it's a question of who's connected to who in a suspicious way and how are they connected. Once we sort of put that together, we can put it into a case. So now we have a case file to pass on to law enforcement, because if you just give I guess our traditional model, just passing tips to law enforcement, they get inundated after a while and they don't know, is this important or isn't it important? But if we can put a case file together for them that tells you this is exactly what's going on and do the initial investigation for them, now they're saying, now we've got something. This is something that we want to deal with. And so that's, I guess, a practical use. Banks and other groups, it's not difficult. There's a lot of RegTech solutions out there that provide that kind of data analytics capability. It doesn't have to be AI. That's probably not super practical, but it's just stuff that allows you to take in multiple data sources, put it against a topology, and tells you this is what's wrong with your client. And so I think that's really where things are headed, particularly as the regulators are starting to dish out topologies and saying, you need to know how to detect this stuff, and we're going to come back and ask you how you do it. And so that's going to completely change the landscape of banking topologies.
Well, I think that's a good, unfortunately, we've run out of time, but that's a nice place to end. And I'd hope perhaps Regulation Asia would be keen to sort of pick up on that area of, how banks are in fact adapting to that. So guys, I wish we could talk for longer on this subject. I really do. But for now, thank you so much for all your insights and time. Very, very much appreciated. All the best to you. Thank you very much.
Thank you.